Hey, it's Jim, and this is level 3 of the CFA program, the topic on alternative investments for portfolio management, and the module on asset allocation to alternative investments. I bet you know that this is another relatively long module, so what we have done is divided it into part 1 and 2. The good news is that there are a number of items inside of these LOSs that we just covered in that last module. Remember, I think that was called hedge fund strategies. So, of course, inside of this asset allocation to alternative investments module, there's an emphasis on hedge funds. So hopefully this will be just a little bit of a review from what we did in that last recording. But of course, there's plenty of new stuff in here. Now, I want you to pay attention to these LOSs as we go through the slide deck, because there are 20 really good questions at the end of this module, and I want to make sure that we cover all that material so that you're prepared to answer those. Brief recap: alternative investments. Boy, you really don't need me to remind you of this, but this is a clear and good illustration. There's hedge funds right in the middle. There's real assets over on the right. There's private equity over on the left, and then a whole bunch of other things that fall inside of those. What are the goals of adding alternative investments into a multi-asset portfolio? Well, I'm going to say the same thing that I did in that last recording. Think about the Harry Markowitz efficient frontier. You know, that non-linear relationship between expected return and standard deviation. What are we trying to do? We're trying to push our way up into that left-hand corner, which means that we're either trying to reduce risk, push the standard deviation over this way to the vertical axis, or push the return upward so that we can generate a higher return. Now, of course, some of these alternative investments are going to allow us to accomplish both of these goals, both risk reducing and return enhancing. Go ahead and skip down to the bottom under hedge funds. You shouldn't be surprised to see that green bar down at the bottom, in which some hedge funds can accomplish reducing risk and enhancing return. Remember, didn't I ask you to put together 6 of those index cards? I'm not going to ask you to do that again in this module, but those 6 index cards hopefully were super helpful, and you'll remind yourself, hey, yeah, there are particular hedge funds that accomplish both of these things. So real assets, risk reducing, private equity and private credit, return enhancing. This probably has something to do with diversification. So wouldn't you know, we have diversification here on this next slide. So what are the roles, capital growth? I mean, I tell my students this all the time. Why do you make investments in general? And you do it in twofold, to generate income and to generate a capital gain. And of course, inside of the traditional investments, like debt securities and equity securities, that's pretty much the limit. But here we have some extra things going on in alternative investments. And look over on the far right. There's what I was hinting at on that previous slide with the concept of diversification. So safety and it doesn't have to be safe out there. I mean, we can have hedge funds that are super risky, but it's possible to add alternative investments to increase safety. All right, so let's look at this first LOS. Explain the role. So there we go. Enhanced returns. And the enhanced returns come from a number of reasons. Remember, what we're trying to do is push that efficient frontier upwards. But what the reading does is emphasize the lack of liquidity in alternative investments, which hopefully I emphasized a little bit, at least a little bit, in the hedge fund group of slides. Illiquidity risk is not present in public equities. That makes perfect sense. So the idea here is that we're going to give up liquidity, but we would only give up liquidity if in fact we were compensated for it, and that's the return enhancement component of this particular role. Now, remember, we did have a number of hedge fund strategies in the colored boxes there. You shouldn't be surprised at any of these. What are we doing with hedge funds, risk reducing or return enhancing? Well, this should be a review. Get out your index cards. Hopefully you wrote one of these down. Long, short equity, short biased. Remember the short biased is that we're going to have most of our portfolio, not all of it, but most of our portfolio in short positions. On the other hand, long short equity strategy is we'll probably have a dominating majority in that long position. Then we have the arbitrage and event-driven. Remember, we talked about distressed securities, which pops up again here in this module, and mergers and acquisitions. And then maybe we'll do some volatility strategies over there for opportunistic. So how about the role of real assets? And I love this particular slide because especially in my upper level finance classes, when we are looking at capital budgeting projects, I have a number of really, really cool problems where we invest in farmland. I typically place it on an island, and that island has a fixed lifetime so that we can have a good timeline. And we do all sorts of fun capital budgeting and capital structure inside of that particular example. But what the reading wants you to know is that, of course, investing in farmland could be direct ownership and it could be leasing. And I always tell my students the story about Sam Walton. The model for Sam Walton was to go into a community and go out to the edge of town, whatever that meant, and, talk to the farmers out there and say to the farmers, hey, how about if you sell me your land and I'll go ahead and lease it back to you over there. You can still grow your corn or your cattle, whatever it is, but I'm going to build a big old warehouse right here. And lots of people are going to come and shop in my store. And this is kind of how Walmart expanded, at least into the United States. And so, that idea of the buy and the lease back, that's pretty important here inside of the role of real assets inside of a multi-asset portfolio. Now, of course, you can extend that to investments in energy companies. I mean, we can invest in ExxonMobil on the floor of the New York Stock Exchange. And the reading, and not just this reading and module, emphasizes that some of these alternative investments provide a hedge against inflation. And that is generally true. But we also know that, this doesn't really help us when there are spikes of inflation. Think of the spike in inflation in late 2022 and early 2023, where you have this spike in inflation, interest rates rise, and nothing good happens inside of the economy. Now, the reason that this is considered a hedge is that if you go out and directly buy an oil well, you're out there pumping the oil, and you're going to sell that for a higher price. So your total revenues will be that hedge against inflation. And so the energy investments, you can do this directly, you can do it indirectly, you can do leasing, you can do all sorts of stuff here. But the reason that the module describes this energy investment, and this is in particularly important for an exam question, is because we like this as diversification. So look there, what do those words tell us? May not be closely tied to the performance of other traditional investments. So if you read that sentence inside of a question stem, you automatically think zero or low correlation coefficient. There's the benefit of diversification. Now, these infrastructure investments, these are really interesting. Of course, a lot of these companies that build bridges and roads and tunnels, a lot of them are privately held. And so, we could get into private equity, which we'll do later on. But there are public companies out there that go ahead and do these things as well. However, you need to consider the simple fact that if a company is going to build a bridge, it's not going to build a bridge over the next 2 weeks. This bridge might take, those of you who live in the Northeast, look at, what do they call that thing in Boston? The Big Dig. I don't really know what the current state of the Big Dig is. I guess I should have looked that up before starting this recording, but I think they started this 100 years ago, and it's still going on. And so remember that example. Notice the words that we have highlighted over there: illiquidity, regulatory risk, and that results in higher levels of risk. So these infrastructure investments are probably most appropriate for those individuals or institutions who are ready for the long term. Commercial real estate, of course, if commodity prices are rising, if food prices are rising, if energy prices are rising, then somewhere along the line, that probably means that rent is going to rise. So that's why commercial real estate is always considered a good hedge against inflation. But again, I'm going to hold my breath and say, well, it depends on what the market is able to tolerate. I mean, think of what happened after COVID. We have all these people working from home. Maybe you guys were some of those people working from home. Did you go back to your office? I mean, now that COVID is, I don't want to say that it's behind us, but clearly it's not in front of us. Have you gone back to work? Is the demand for those commercial spaces, is it still as high as it was, back in, let's say, 2018 or so? So keep this in mind. It is a good inflation hedge, if, of course, there's the demand for that commercial real estate space. Look at the green bullet point there. This swings us back to an earlier slide where we want the capital gain and we want the income. All right, how about private credit? What we can do is we can directly lend, or we can invest distressedly. This is what we talked about in that hedge fund universe with some of those strategies. Does it matter if you have a client who has, let's say, this much risk, however you want to measure that risk, standard deviation or beta or whatever it is, and you buy a share of stock for $200, and that stock appreciates to $300, right? Well, that's a good deal. Sounds like a good deal. Or does it matter if you bought a $200 bond that is double C rated and it hasn't been making any coupon payments, and you buy it at $200 and it increases in value to $300? There's the same capital gain. That's why that distressed investing, especially if you're investing in fixed income securities, that analysts take a look at those as, very, very closely resembling to equity securities. Now, distressed investing can mean lots and lots of different things, not just in bonds that have very, very low rating. And remember, I'm going to go ahead and put a comma here, and I'm going to remind ourselves that, look, when you consider fixed income securities, and maybe they're distressed securities, of course you're going to look at default risk, and we'll look at Moody's, we'll look at the credit default swaps. But please don't forget to consider interest rate risk. I'm pretty sure SVB was hoping that nobody would notice that it was exposed to tons of interest rate risk when in fact it was. All right, notice down on the bottom, there's once again this illiquidity. So we're probably going to go ahead and expect some type of compensation for taking that extra risk. Here we go. This is what I was just saying. Risk return profile similar to equity securities, potential for the company to recover and restructure. And so there are lots of different ways that companies can get out of this distressed environment. Among the best reasons is to be taken over by a private equity firm and then recover because there's better leadership or better skill set or better board of directors or more focus on core competencies. I mean, the list goes on and on about what happens in that distressed investing. All right, how about risk mitigators here? And once again, this probably depends on the investment horizon. And so let's go ahead and take a look at how we can reduce volatility over the short term. And, skip down to the bottom and look, we have this highlighted twice. Low correlation, zero correlation, perhaps even negative correlation. So that's going to make our return volatility more narrow. Maybe it'll say that in the question stem. Maybe it'll say something like, hey, we expect standard deviation to fall by, 15 or 20% over the next 6 months because we've added, whatever these alternative investments might be. So that's probably a good thing to know for the exam. Now, this is not perfect. Let me go back here quickly. This is not perfect, a reduction in returns volatility, because of how we compute that correlation. We might have to put appraisal values in there. And I'm guessing that you know this from your own homeowner's situation. The assessor comes by and they take a look at your house, and they may or may not ask if they can come into your house to take a look at its condition. You can do whatever you want. You can allow them to come in, or you can not allow them to come in. But if they don't come in, they have to look at the outside, and maybe you don't even let them on your property. So they have to, I don't know what they have to do. Maybe go over to the next neighborhood and get their binoculars out, whatever it is, to try to figure out what the value of your home is. Well, we don't really need binoculars for all alternative investments, but boy, how do you calculate the correlation between, let's say, the returns on Johnson & Johnson and a piece of artwork that you bought 10 years ago for $1 million? That's virtually impossible to calculate it, but you can estimate it. It's better to estimate than to not. So that makes good sense. There are also some biases. We've talked about survivorship bias lots and lots of times, backfill bias. So you probably know those things. And then those hedge fund indexes, they're probably going to have low correlation. That makes perfect sense. All right, how about we decide what to do if we have this client? And remember, I haven't said this yet in this recording, but I think I say this in almost every one of our level 3 recordings, that the focus here is on the policy statement. So you meet with a client and you put together that policy statement. So you have the constraints, you have the risk and return objectives, and you say to your client, all right, from what you've given me, we need to have a return objective of 10% with a 17% standard deviation. All right, so what we're going to do, we're going to have regular old fixed income securities and equity securities, and then we're going to throw a bunch of this other stuff in there that we call alternative investments. So what is the risk of not meeting that goal over the long term? So what do we have to do? We have to worry about that rate of return, right, earned by the investments. We don't want to be too concerned about the ups and the downs. We'll have to educate our clients that up times and then there are down times. But what we want to make sure that we do is that those little squiggly lines, the up and the downs, that they have an upward slope, they have a positive slope, so that we can battle inflation. We want to overcome inflation. We want to earn a real return. Remember that from back in level 1. And then we need to be concerned about those required annual distributions, depending on what kind of a vehicle that we're using. So here's a good and quick example about fixed income securities. Volatility in the equity markets. We're considering using bonds or some private credit to reduce the fund's exposure to equity risk. So when you read that in a question stem, automatically think of something that sounds like, all right, we've got this equity portfolio and the beta might be 1.2 or 1.6 or 1.8. What we're comfortable with is maybe a 0.8 beta. So we want to reduce the fund's exposure to equity risk. So we want to lower beta. How do we do that? Well, we can add fixed income securities and we can add private equity. So the question here asks us to explain advantages and disadvantages. And so here are some really good reasons here. So there we go. Opposite directions in a low inflation environment. Now in 2023, we just throw that out to the window. So I'm hoping that when you watch this in 2024, that we're back to a low inflation environment. But remember that when we have high inflation environment, that the returns on bonds and the returns on equity securities, those correlations probably move more in the same direction than they do in low inflation environments. So look for low or high inflation inside of the question stem. There's that sentence in there about reducing overall volatility. Yeah, negative correlation may not always remain negative. That's what I was saying earlier. How about private credit? Boy, look at equity beta of private credit is around 0.4. So, boy, add a 0.4 to your portfolio of, what did I say earlier, 1.2 or 1.6. So that makes perfect sense. But you got to be concerned when we go to this private credit market. There's probably going to be some extra leverage, maybe because these are actively managed. There might be substantial losses, and so we need to monitor. So remember, the Institute is so keen on your understanding of being able to identify the risks, quantify the risk, and then manage the risk. And part of that managing the risk is monitoring. And so, boy, it makes perfect sense then to go ahead and monitor those levels of leverage. All right, how about some traditional approaches here and risk-based approaches? What are we doing? So we want to properly define the opportunity set, right? We'll go back to the policy statement. So we have this conversation with the client, and the client says something like, yeah, I'm okay with fixed income securities. I want to take this much risk. I'm okay with equity securities, and I want to take this much risk. So it's up to us to figure out what this much and what this much means, and what are the relevant and the appropriate securities to fit into those traditional characteristics, those traditional investment opportunities. But then when we throw in this category of alternative investments, we have to ask the same and similar questions. What kind of alternative investments are you comfortable with? Private debt, maybe, art, maybe. How about a stamp collection? Maybe. How about a hedge fund? Maybe. And so we can do this liquidity-based approach and risk-based approach. I mean, these things are not clever. We're not really trying to hide anything in naming these. Liquidity-based approach, what are we thinking about? We're thinking, okay, if we need to sell some of our assets because we either want to do something over here or we're obligated to do something over here, well, how much of a discount are we going to have to take? I think we call that a haircut. How much are we going to have to take in order to get our money back so that we can meet this obligation? And then risk-based approach. This has its roots, of course, back in Harry Markowitz. All right, let's look at the difference between public and private alternative investments. Of course, the private being the less liquid of the two, and maybe way less liquid. I'm not sure that's a finance term, way less liquid. I know there's a really, really great Rat song from the old days called Way Cool Jr. There's your homework assignment. Maybe if you think of Way Cool Jr. and way less liquid, you'll be able to answer this liquidity-based question on the exam. But of course, whenever there's liquidity, then look at the very bottom. We have this time commitment highlighted and bolded, and then longer time horizon. So think about linking your client with a longer time horizon and the ability to go ahead and invest in private equity over that longer time period. Because look, as an analyst, and you have these clients, you don't want your client calling you, every 5 minutes saying, what's the balance on my portfolio? What's my time commitment, et cetera, et cetera. My father, during his lifetime, was a short-term investor, and he used to pester me all the time, and I didn't even manage his money. But every time he lost money, it was always my fault. I'm not sure that this is that valuable of a slide for you to get out your phone and take a picture of this, but I'm going to go ahead and say, let's do this anyway. You'll have this beautiful picture here, fixed income, equity, and real estate, and there's a good breakdown of liquidity and illiquidity. What this will do for you is during a question stem, the Institute will say something like, here we have equity, we have public equity, and we have private equity. What's the difference? And you might have to answer a question on a statement, and you might have to say, one's liquid and one's illiquid. This table will really help you do that. Now, I'm also certain that you're keenly aware that the Institute loves linking the business cycle back to almost everything else that it does. So if you remember in level 1, level 2, and level 3, there are LOSs that say something like, during the stages of the business cycle. That's why we emphasize that so strongly back in our level 1 video. So capital growth assets, inflation hedging assets, and deflation hedging assets. And so these are pretty self-explanatory. Of course, we want to invest in equities during an expanding economy. I've said this many, many times before. What are we trying to do? We're trying to find positive net present value projects. If we find those and enough companies and enough industries and enough sectors find positive net present value projects, then the economy will expand. The idea is to find the best industries, the best sectors, the best companies that are going to be on the upper end of that economic expansion and the upper end of the tons and tons of operating cash flows generated by those projects. And then inflation, we spent tons and tons of time talking about inflation. Now, the risk-based approach, on the other hand, is much more granular than the liquidity-based approach. You should have noticed in those previous slides, we had liquid or illiquid, but here we need to take a look at all of the factors that we've described since some of the early days of level 1. So look at these risk factors. Of course, liquidity is just one among these. And then we have interest rate risk. We'll call that purple, and duration. In fact, I just read a Wall Street Journal article just this morning or this afternoon when I was eating lunch. And somebody was being interviewed regarding bank failures and all this kind of good stuff. And his comment was, this was a quote that said something like, "Oh, yes, this is duration-based risk." And then in the next paragraph, the author of the article explained, "Oh, yeah, this means interest rate risk." So just be prepared for duration risk or interest rate risk. They pretty much mean the same thing. Now, inflation down at the bottom, you need to now the reading doesn't do this, but you need to kind of throw the inflation all the way over to duration because, when you have spikes in inflation, well, then interest rates are going to rise, and then that means we're going to have interest rate risk. And then, of course, we have size, we have equity market returns, and then credit spreads. So the opposite of the interest rate risk under duration, the opposite is, let's just call it default risk or credit risk in general. And so we need to worry about all of the spreads. Now, the LOS doesn't really ask us to go back over all of those different spreads that we learned back in level 2. Do you remember that? We had the nominal spread and the G spread and the option adjusted spread. I'm guessing that and hopefully you remember these kinds of different types of spreads. So that knowledge from level 2 probably helps you answer a question here in level 3 on credit spreads. So just remember liquidity. Here, let me go back here real quick. We either have liquidity or illiquidity. Here, liquidity is one factor inside of that risk-based approach. Here we have a quick example here, returns of private equity, similar risk to those of publicly traded equity. Private credit, similar characteristics to high yield bonds. Yeah, that makes sense. All right, what are the advantages of this risk-based approach? Wow, common risk factor identification. When I showed you, here, let me go back here. When I showed you this illustration, you weren't shocked. There's nothing over there. There's not a circle over there that says something like photosynthesis. I don't even know what that means, but it has something to do with leaves and greens. So common risk factors, we've talked about these before. So that means that they're easy to understand. They might be easy to identify. Now, of course, the implementation and the quantification, well, that's why we did all that stuff back in level 2 and even a little bit in level 3. Integrated risk framework, of course, we have all those different circles. Of course, sensitive, look back period. I've said this multiple times. I tell my students this all the time. You go back. In fact, my students were just doing a project on Caterpillar. And, they wrote about Caterpillar over the last year or two. And I say, okay, that's fine. But what's more important, the last 2-year period or the last month? What's more important? So disadvantage, sensitive to the period used, and then there are all sorts of implementation hurdles, liquidity planning, manager selection, rebalancing, all those things that are critical as elements of the policy statement. Well, they're not free, first of all, and they take time. How about another quick example here? We have Chief Investment Officer, risk-based approach should be adopted. Let's see, describe the most likely limitations. All right, false sense of diversification. That's kind of an interesting concept. But in order to overcome this false sense of diversification, we need to be able to handle those correlation coefficient calculations. And even though none of the LOSs and the CFA program doesn't include copulas inside of this. This is where the Institute is probably going forward. We'll do correlation analysis, and we'll go ahead and talk about copulas. You guys can forget about those for the exam, but still, there's lots to do in this area of understanding the relationship between and among variables using things like marginal distributions and contingent distributions and all those fun kinds of things. Now, let me go back here real quick. Let's suppose that my example of photosynthesis, whatever that means, that is part of an elemental risk-based approach, but we don't include it. And so what does that draw back here? What does it say? Hidden primary risk drivers. And so maybe we're ignoring it. Maybe we don't know what it is. Maybe we're not comfortable with it. Maybe we don't know enough about it. And there's some good examples in there down at the bottom. Now, how about we get into what I think is among the more interesting LOSs inside of this reading. How do we allocate different types of alternative investments? You remember that we had this idea that the traditional of 60% and 40%, and we could divide that and we say, okay, 48%, 32%, and now 20% allocated to alternative investments. Well, how do we pick which of those alternative investments are going to fit into that 20%? Well, of course, the answer is we need to go back to the policy statement and find out what the client is able and willing to do from a risk perspective. So here's another little kind of a flow chart in a circular fashion that tells us about some of these considerations. We've talked about these before. There's liquidity issues. Go down to the bottom. There's properly defining risk characteristics. I said that earlier there, establishing return expectations. So that has everything to do with our macroeconomic analysis, our industry analysis, our security analysis, and then what is that return objective for the client? That has to link with those returns that are available in the secondary and the primary markets. So then skip over to the purple and say something like, all right, well, which of these alternative investments have these particular return characteristics and have these particular risk characteristics that fit into to the policy statement? And then don't forget the green up there. We spent a lot of good time on expenses, fees, and then the tax implications. It doesn't make any sense if we go to a hedge fund and the hedge fund takes our $100 and turns it into $200. But the hedge fund then says, wait a minute, we have this system where what we're going to do is we're going to take part of that capital gain. What was that capital gain? $100. We're going to take 50% of that for ourselves. And then, oh, by the way, didn't you see that the local governments and the federal governments, they now have a 50% tax rate on all capital gains. So there, that wipes out your other $50. So the hedge fund takes the first $50 of capital gain, taxes take the other 50%, and you're still left with 100, right? So that makes perfect sense. So how are we going to properly define risk characteristics? Whoa, what are we starting out with? We're starting out with Harry Markowitz. We've got the efficient frontier in that expected return and standard deviation environment. And we can do that very, very easily in Excel. I do this all the time with my investment students. It's so super easy to use Solver. However, it's not perfect. It's not perfect for a number of reasons. And I really illustrate this to my students. And hopefully this will help you in some LOS. Maybe this LOS, but maybe a different LOS from a different module. But when we go into the Black-Scholes-Merton option pricing model, the only variable that we really don't know about is the standard deviation. So I ask my students, how are we going to compute the standard deviation of an underlying share of stock in order to use it as an input variable? And they inevitably, they raise their hand or they say, you know what, Jim, you taught us this in investments. We just go to Yahoo Finance, we go to Procter & Gamble, we get the last 3 years worth of daily returns, and we compute the standard deviation. And I'm saying, hey, wait a minute. Yes, we did that. And that was appropriate for us to do, and that might be appropriate now. But there are limitations to A, using that historical data, B, to applying standard deviation into the alternative investment world, because while we know what the Johnson & Johnson stock price is every day, we probably don't know what the alternative investment value is every day. And then what about secondary markets? What about skewness? What about kurtosis? What about value of risk? What about? So we love Harry Markowitz. We're super proud that he won the Nobel Prize in economics. It gives us a great starting point, but because of illiquidity, because of valuations that include, however we're going to value it. What did we talk about this earlier? Some kind of assessed value. But then there's look in the purple, non-normally distributed returns. That's what I was talking about with the skewness and the kurtosis. So you ready for this? This is a terrible analogy, but we love Harry Markowitz. But we're not quite sure that we're ready to commit to marriage to the Harry Markowitz model because of these things. We love Harry Markowitz. We want to spend a lot of time, but maybe we don't want to sign a contract with the local municipality saying, well, I want to marry the Harry Markowitz model, till death do us part. I don't know if that's a good analogy. I think it is, but my wife is never in favor of some of my analogies. All right, so how do we go about saying, here's the Harry Markowitz that we love. How can we turn it into something that we're willing to spend the rest of our lives with? Well, here are some examples, and these are not perfect. And so I'm not quite sure. I really struggled to figure out how I would ask an exam question about this. So look at that first teardrop point. A higher standard deviation is assigned to alternative investments. So I'm just going to scratch my head and say, okay, this is what the module asks us to do. So we're just going to go ahead and say, let's assign it a higher standard deviation. Let's live with that, and let's use that answer on the question, knowing full well that just assigning a higher standard deviation may or may not be accurate, and then we bring in other kinds of risks. So forget what I just said over the last 30 seconds. May not accurately reflect the true risk profile. That's what I was getting at there. And any assumptions that we make about primary markets and secondary markets, and think of the floor of the New York Stock Exchange. I mean, these people have been doing it all the way back since before 1800. So you pretty much get the sense that they know what they're doing. But what about hedge funds, which hasn't been around since 1792? What about private equity, which hasn't been around since, well, I guess private equity's been around for a really long time. But the formalized private equity that we have here in this alternative investment framework has not. And so in the blue box, there are a couple of other things down there that we've talked about before. But look at that very bottom thing. I love this because it's concerned about linking back to the policy statement. We have this target allocation, and that might not be consistent. All right, how about some extra problems here? Short-only strategy. What do we know about shorting a share of stock or shorting any kind of an asset? Well, if we short an asset and its value is 100, what's the most we can win? Well, if the price falls to zero, we win $100, right? There's our capital gain. We bought at zero and we sold at 100. But let's suppose it goes up to 200. Well, there's our $100 loss, but then it can go up to 300 and 400 and 3 million, right? So unlimited loss potential. And that short-only strategy, it really complicates modeling. It complicates Harry Markowitz, especially in Solver. It complicates factor analysis. It complicates the Black-Scholes-Merton option pricing model. It complicates all sorts of things. So remember that, complicate modeling investments. Now, suppose that we want call options. Well, remember, we can do this in one of two ways. We can go to the floor of the options exchange and just buy a call option. Right? We can do that easily. Or we can use put-call parity or some other kind of relationships that may exist out there, and we can synthetically replicate a call option. And synthetic replication of a call option, remember I said this to you back in that particular module, synthetically replicating does not mean that we're perfectly replicating. And so you bring in other kinds of risk, and you may not get that return enhancement that we were hoping for back in the early part of this slide deck. Yeah, returns of alternative investments can be more difficult to predict. Of course, they can be more difficult to predict. That's why we said in that slide or two again, let's just go ahead and assign a higher standard deviation because they're more difficult to predict. There might be some other factors out there that are not relevant for fixed income markets or equity markets. And so it's up to us as good financial analysts to try to figure out what those factors are. What the module suggests is exactly what we did back in level 1. Remember when we were trying to find out about what is the yield to maturity on a fixed income security. We did this building blocks approach. We started with the risk-free rate, and then we added a liquidity premium, and we added a maturity risk premium, and we added an inflation premium. So this is what we're going to do here, but what have we said all along here? More difficult to predict, may complicate things, so we may have to take a different approach. So this building block approach here in this module is similar but not identical to what we did before, but clearly you can use your knowledge of that yield to maturity and the key determinants of a yield to maturity here. Whoops, sorry, I didn't mean to go ahead. All right, so what are we doing? Estimate the expected return with those factor exposures to a relevant asset class. So if we have a client who has invested in artwork, well, let's go out and figure out what is or what are the relevant factors inside of that art world. I don't know anything about the art world, but I'm guessing that some of you do. Some of you who are experts in this particular field will say something like, okay, is the painter, is he or she alive or dead? That's probably a factor. I don't know, making this up. What was the last selling price of one of this artwork, and how did that compare to its previous 10 selling prices? So there's probably a factor somewhere in there. You can compute maybe a semi-standard deviation. You could probably throw in some kind of expected exposure in there. What if the market for artwork crashes? You know, there are all different sorts of things that you can throw into that green box. Now, I guarantee you, boy, I hate to say that with the Institute, but I'm virtually guaranteeing you that the Institute is probably not going to ask you to come up with factors for artwork. But if they do, they'll probably say, of the list of factors here for artwork, which ones do you think you should consider? And boy, you know, we could just use our regular old mosaic theory to figure that out. What else are we building on here? Apply some kind of an assumption for the manager alpha. So these could be factors in and of them kinds of themselves. But that purple box there is going to say something like, well, let's go ahead and look at the manager's history, see what kind of standard deviation or what kind of risk, and let's make an expectation for that particular alpha, which includes all different sorts of factors. And then, of course, we need to subtract out those fees. All right, here's kind of the dull part of this reading, right? We have a general partner, we have a limited partner. So those have, kind of implications. These don't sound like exciting exam questions to me. I would just think that the Institute in the question stem would say, hey, here's this general partner or here's the limited partner. They might give you some information on either of these two individuals or groups of individuals that make up the partnership, and they might say something like, where are these relevant? And so, there's the, you can go down to the bottom and you see what of that choice of investment vehicles can be used. So we can do this direct investment in the limited partnership. What we're trying to do here is probably find some kind of element of diversification, but look up at that first block point there. What do we have bolded? Operations, strategies, the industry, a great understanding of the partnership's characteristics. The LPs may choose to co-invest, that's probably an important thing. Fund to funds, we spent some good time back in that previous recording talking about fund to funds. Separately managed account, these are exactly what we talked about. I think we did this in level 1, but surely we did it in level 2. Look at the second block point there, high minimum requirements, probably easier to implement. And then we have all these other kinds of funds, open for smaller investors, more regulated. aim to replicate some alternative investment strategies. There are some mutual funds out there that say something like, look, this is a balanced fund. We'll invest in some fixed income securities, we'll invest in some equity securities, and we'll invest in these kinds of alternative investments. And so you'll have a sense of what's going on. Yeah, once again, back to the liquidity issues. These are pretty self-explanatory. Lockup periods, redemption restrictions, illiquid underlying assets. That makes sense. Here's another slide that probably is a replay of what we did in the previous hedge fund strategies. What is our focus here with this LOS? Really just, these different considerations. And so you probably know all those about hedge funds, other alternative investments, redemption, probably not. Lockup period, 10 years. Secondary markets, we know that we love the floor of the New York Stock Exchange. There might be a secondary market for this artwork that I was suggesting just a few moments ago, but it's probably not going to be equal to the secondary market for shares of Johnson & Johnson on the floor of the New York Stock Exchange. Of course, there are margins and there are calls, and these things can be done in stages. We might say something like, hey, if I'm this manager, I might say something like, send me $1 million today, and then in a year, send me another $1 million, and in 2 years, send me $5 million, and then you can have access to it in 5 years or 10 years, or lots of different ways to arrange this, as long as it's outlined in the prospectus, almost anything goes. So look at that bottom down there. Capital calls done in stages. Now, what about the timing and the amount of these capital calls? Suppose we have this private placement memo. Yeah, what's going to happen? And this is what I was saying earlier about the prospectus. Of course, this PPM is given to investors. That's all just part of the ethics of the model. Current stages, usually 3 to 5 years. What did I say? 2 years, and then 4 years, and then 6 years. Usually 3 to 5 years, but it could be almost anything. What we need to do is worry about the opportunity cost. So the longer that you have your capital tied up, and the greater is this PPM and the calls, well, then you're going to give up liquidity, which means you're going to have an opportunity cost. So sometimes that's okay. Sometimes it's not okay. How about equity-oriented hedge funds? Boy, we spent a lot of time in that recording. Let's just quickly go over this one here. What are we tending to hold? Shares of Procter & Gamble or Johnson & Johnson, so liquid investments. Convert their investments into cash quickly. Short positions are much less liquid. We might have these pockets. Maybe we'll call it a side pocket. Maybe we'll call it something else, where we throw some of these less liquid assets into it. Maybe they're not subject to the normal redemption terms. But I'm guessing that the Institute would probably explain this to you in the question stem. So just look for keywords: short position, look for redemption requests, look for side pockets. How about event-driven hedge funds? Let me just remind you quickly of these things. They could be almost any event, but in that last reading, there was a focus mostly on mergers and acquisitions. There was a slight discussion on distressed securities or bankruptcies, but this could be something just as simple as a special dividend or a share repurchase. So I would lock in on mergers and acquisitions just because we spent so much time on that in the previous reading. But don't be alarmed if there's some other kind of an event. Frequent redemption periods, I think we talked about that. That prevents full realization of those potential returns. And look down at the bottom, there's a longer commitment period. Relative value hedge funds. Boy, we talk about relative value going back to level 1. So what does that mean? We have a value here, and we have a value here, and we need to compare those two. Relative value funds in those underlying assets, significant portion of illiquid assets. There's probably going to be a restriction especially under certain market conditions. I mean, if everyone's happy, if the market is expanding and asset prices are increasing, there might be a relaxation of these redemptions. But boy, there's some kind of protection involved in here as well. Look down in that orange bullet point, cascade of redemptions. We had some slides on the cascading. How about leverage? Of course, leverage simply means that we're taking on some type of a loan. I mean, it might be an explicit loan or it might be an implicit loan. Of course, the most common of these is a margin requirement. And so we need to worry about margin requirements and margin calls, especially during a downturn. But if we're short, we need to worry about it in a market upturn. Yeah, here's a good slide on expenses, fees, and taxes. We've been through this. We did some good math, especially on the 2 and 20. It might be a good idea for you to go find that slide. I'm pretty sure I asked you to take a picture of it whenever that was, just to remind yourself of the math. That'll be good for that old LOS, and it's probably appropriate for even better understanding of this LOS. So what are some other expenses? Well, there we have some circle points there. Yeah, how about taxes? We got to worry about taxes. And so, boy, there might be different taxes look down at the bottom, real estate, for timber, for energy. Sometimes we'll get one of those forms that there's federal withholding. Well, that's probably important. We'd love to have federal withholding on April 15th. We don't love to have federal withholding when it is withheld during the course of the year. I'm guessing the Institute is not going to require us to be experts on the tax structure or the U.S. tax code, but this is just part of, what does that LOS ask us? Just maybe to discuss the investment considerations. The taxes, of course, are an investment consideration. Yeah, do we want to invest in industries to reduce the overall tax burden? This makes perfect sense here. Don't forget that you're allowed to deduct a capital loss up to a certain amount. So we might want to, use some kind of tax planning there. Look at this. Difficult to do accurately estimate annual income from these alternative investments. That shouldn't be a surprise to you at all. That's why we have the money and the gavel going down on the bottom right. Before we go on to the next slide, I wanted to mention an example that is given inside of the module. There's a really cool example in which there is a small endowment fund which is made up of a bunch of individuals on the board, but then there's an investment committee that consists of the chief investment officer and then 2 analysts. And part of that question says something like, are these 3 individuals, are they smart enough to do this in-house kind of an evaluation, or should we look for an outside consultant? So I wanted to alert you to that potential exam question. Look at the bottom there. The returns generated can justify any additional expenses. So really the in-house decision is one of, are the individuals on the board or in the investment committee, do they have the skills and the talent and the willingness to be able to go ahead and figure out what we want to do on the alternative investment side? So here are some factors. Do we need super customization? If we hire an outside manager or a consultant, how easy it is to get in touch with them, what kind of resources and expertise is available, and how easy is it to access those key decision makers. And so this is super important. This goes back to lots of risk management principles that we've talked about, mostly in level 2 and some even in level 3. Notice that the first teardrop point, large investors like that endowment fund example, they're probably going to use this in-house program because, what are you learning in this in level 3 and even level 2 is that alternative investment knowledge is not too different from, fixed income and equity security knowledge. It's just something different. So we need to work at it and figure it out what's unique about it, and then we can master it. So this is probably the good exam question. Require specialized solutions, greater level of control, co-invest with the general partners. This is probably suitable for the in-house. All right, so here we go. Final example, small nonprofit organization, diversification. Yeah, what do we want to do? 15% private equity, the internal investment team. There we go. Chief investment officer and a few analysts responsible for developing an implementation plan. What are the key considerations and factors? So what are we considering? Size, is that 15%? Is that consistent with what shows up in the policy statement, which of course the chief investment officer, probably wrote. So 15%, and then what's the dollar amount of that? The size, is 15%, is that $1 million or is it $1 billion or is it $1 trillion? Because then we need to figure out how are we going to invest $1 trillion out there in the alternative market without people knowing about it, so that we're not faced with all of those direct and indirect costs of trading that we did. When did we do that? Back in level 2. Team's expertise, that's what I said. Available resources. My students are so blessed because they have the Morningstar software in our trading lab, and we have the Bloomberg terminals. We have 12 of them inside of our lab. I'm sure I've told you that before. So that's a tremendous resource. Now, of course, Bloomberg is limited in its alternative investments, so there are other avenues out there for resources there. Constraints, committed enough capital to achieve diversification. I mean, it's one thing to invest in, what did I say, a piece of artwork that we bought 10 years ago for $1 million. Boy, that correlation coefficient, maybe it's 0, but maybe our entire portfolio is worth $1 billion. So really, do we care about a correlation between one piece of artwork that's $1 million versus $1 billion portfolio? So that's the committing enough capital. So I'm guessing the Institute might try to fake you out. They might try to slip something in there where they say something like, here's a portfolio, $1 billion. Here's a piece of art, $1 million. Do we care about it? And we probably say no. The team may recognize utilizing a fund vehicles. Let me just have you get out your index card from the previous reading. Look over that fund-to-fund index card so that you know exactly what we're talking about there. May not require the additional financial resources. So we know all that stuff. So this is what I want you to do. Just reminding that we've done half of these learning outcome statements. I'll come back and we'll do the last 4. I'll do that relatively shortly, so you'll be able to see part 2. There are 20 questions at the end of this module. What I want you to do now is I want you to take an extra, let's say 15 minutes of your time and just skim the questions. Take a look at what the question stems look like, what those possible answers are, so that you get a sense of this. In fact, I'm going to ask you to go ahead and cheat. Go ahead and look at the answers. I mean, you don't really have to look at the questions and then the answers, but go ahead and read through the solutions so that you know what the Institute is thinking. I want you to do that over a relatively short time. So there's 20 questions. Do that over 10, just spend 30 seconds on each question. I don't want you to bog your mind down here. But then when we're done the next series of 4 LOSs, I'm going to ask you to spend 30 minutes on this, and I'm going to ask you to go back and take this as a practice test. So, hey, thanks for watching. Note that part 2 will be coming up super shortly, and have a great day.